I have the pleasure of introducing our keynote speaker, Peter Bart, the Vice President and Editor-in-Chief of Variety and Daily Variety. Prior to his tenure at Variety, Mr. Bart held a number of senior positions within the entertainment industry, and before that spent 10 years as a staff reporter for the Wall Street Journal and the New York Times. He was also a consultant to the Ford Foundation and lecturer at the Salzburg Institute for American Studies. Peter's wide experience and perspective have made him one of our industry's most respected voices, and he's an important bridge between our business and the world at large. We're very fortunate to have him with us today. Peter Bart.
Good morning, everybody. Thank you for coming here in such dreadful weather. I was pleased that the theme of this conference today was the money trail, because in my varied and never boring career in show business, I was mentored by several illustrious individuals who were, you might say, aficionados of the Hollywood money trail. My first boss was that corporate conquistador, Charlie Bluedorn, who saved Paramount from bankruptcy, but because of his fondness for picking pictures, particularly musicals like Paint Your Wagon and Darling Lily, almost plunged it back into bankruptcy shortly after buying the company. Bluedorn was one of these people who has a brilliant financial mind, but any filmmaker who would take the time to pitch him a project or hum him a tune, Bluedorn was an instant sucker. And it wasn't until he finally surrendered the reins of production and stopped picking pictures that things suddenly took a stunning turnaround. I remember the first hit that we had, a huge hit named Love Story. That takes you back a few years. I happened to be in Manhattan with Bluedorn, and we were driving around in the limousine together. We went to one theater and then another theater, and there were lines around the block. Now, this was before the days that the blockbuster was an accepted commodity, and it was absolutely stunning to see lines around the block. I was thrilled, but I noticed as we went around Manhattan, Bluedorn kept on getting angrier and angrier. Finally, he couldn't contain himself anymore. We stopped at some theater on 3rd Avenue. As a theater manager was standing next to the box office looking euphoric. Bluedorn goes charging up to him, starts to shake him by the lapel and says, "You fool, you schmuck, what are you just standing here for?" And the theater manager said, "Well, what do you want me to do?" And Charlie Bluedorn said, "Look at these people waiting to get in. Raise the fucking prices." Well, that was Charlie's idea of the money trail. My second gig was with a remarkable man named Merv Adelson. I was president of Lorimar Pictures, and when I took over at Lorimar, the number of pictures I inherited that were completely unreleasable astonished me. Yet, as we started, my management kept on saying, "Make more pictures, make more pictures, make more pictures." I couldn't figure out for the life of me what the money trail was at Lorimar, where the money came from. But I did notice that all of the staff meetings took place at La Costa, and in which Adelson had an interest. And it was helpful to my business education, because I occasionally, after meetings, I'd sit in the steam room, and from out of the steam, out of the clouds, I would hear sophisticated discussions of business objectives. Like one man would say, "Who's going to whack Louis in Cleveland?" My third job in the business was under a man of great civility named Kirk Kerkorian, who, as you worked with him, was a very dignified and in some ways, though distanced, rather lovable individual. And I remember the problem with Kirk was that you could never engage him in business discussions of any sort. And once at a dinner party, it was a quiet dinner party, sort of took him aside, and I saw my chance, and I said, "Kirk, there's one thing I've always been wanting to ask you. You know, this is an era," this story takes place in the mid-'80s, when David Beagleman, the late David Beagleman, was rather excessive in his level of profligacy at MGM, and it was Kirk's money. I said, you know, this is a moment in film history when more and more the studios are using OPM, other people's money. And you keep using YOB, Kirk, your own bread. You keep writing the checks, and I don't really understand why. And he looked at me thoughtfully and sort of furrowed his brow, and I thought he was going to give me an interesting answer to this. But finally he said, you know, Peter, did I ever tell you about the time I sold a used 707 to Howard Hughes, and he returned it to me because he claimed that the plane was radioactive because it had sat in Las Vegas too long. I could see that Kirk had no intention of responding to me on the subject of business. We're talking about airplanes. That having been said, I find that the task of exploring the money trail in Hollywood is an extraordinarily different exercise than in any other industry. Because in Hollywood, one has to examine the complex equation between capital and creativity. Like it or not, people and companies only profit in this town. Only profit in this town if the collective creative output of the community shows sufficient flair and innovation so as to inspire consumers around the world to allocate their discretionary spending toward entertainment. No matter how complex and fanciful the deals or intricate the negotiations, it all comes to a thundering halt if tickets aren't sold, shows aren't watched, CDs aren't purchased, videos aren't rented, and so forth. In short, the capital has to nurture the creativity. And in a landscape that's increasingly dominated by multinational corporations, there are some cautionary questions that could be asked as to whether this fact of life is really being accommodated. Indeed, if you follow the money trail as it snakes across the entertainment economy, you may find that it's starting to flow in directions which in the long run may run counter to the health of the industry. Take the dogma of vertical integration. Now, if you turn back the clock a few years, and all the Wall Street seers were singing the same song, to wit, that the only companies that could survive in the competition in today's entertainment economy were those that effectively owned all the means of production and distribution and that held a dominant position in ancillary industries, theme parks, music, exhibition, and so forth. Of course, this prognosis was uniquely self-serving in that it created a field day for mega mergers. So all the M&M boys were making out like thieves. Look around today, however, and you begin to wonder whether vertical integration has begun to fizzle. Universal sheds its television interests to Barry Diller. Viacom decides it wants out of the publishing business. The other day I get an analyst report saying that MGM was a good stock to buy because it represented a pure play investment. I think to myself, pure play, those were dirty words last year. And what's next? Will Disney decide to shed Cap Cities? Will Rupert decide the movie business isn't what it's cracked up to be? In short, has Wall Street been pulling Hollywood's chain? The most recent example involves the exhibition industry. On the one hand, we have two of the sharpest leveraged buyout mavens, KKR and Hicks Muse, bent on consolidating the exhibition business. They're going to achieve economies of scale, they tell us, presumably by buying popcorn in bulk. On the other hand, we have veteran exhibitors telling us, forget it, this is a weird strategy. The biggest cost item, after all, is film. And you are not going to pressure the distributors into draconian revisions in their pricing structure. Even that sage Sumner Redstone says, you know, I think I understand the strategy. These are smart guys, but I don't know what the hell they're thinking. One explanation is that the exhibition industry is falling victim to that mantra, that bigger is better. But is it true? The noisiest current proponent of this doctrine is none other than James Cameron. In accepting his Golden Globe, Cameron reassured us that the real message of the Titanic was, remember, size does matter. He didn't get much of a laugh. And I think one reason was that many in this community are uncomfortable with the fact that awards are being showered on a filmmaker who all but boasts of his willful disregard for the precepts of fiscal responsibility, and indeed for the budgeting process. Sure, Cameron made a movie that is a huge moneymaker. In some ways, it's the ultimate event movie. It may be the first billion-dollar movie ever made. But would it have been a lesser event had it cost $100 million less or been a half hour shorter? Or if the director had simply told the studio at the beginning, look, boys, I don't have the vaguest idea what this movie will cost. The success of the Titanic sent a chill through the production community because it served as a vivid reminder of two realities: the unbridled power of top directors and the inability of the studios to control the outcome of action movies that are dependent on special effects. Cameron himself believes he has proven once and for all that bigger is better. Though I would like to see someone run the numbers on movies like Bean and The Full Monty, and let's see whose profit margins are a little more attractive from the standpoint of business. But if the proposition that bigger is better is subject to attack on a picture-by-picture basis, it's even a shakier proposition on the corporate level. Is it a mere coincidence that the studio, having the greatest difficulty in adjusting to ever-changing and whimsical public tastes, is owned by the biggest media company, namely Time Warner? Warner's hasn't swerved from its basic modus operandi for more than a decade, irrespective of a changing marketplace. And it won't. Would anyone seriously deny that a Harvey Weinstein can make quicker adjustments than can a Warner's? Watching Warner's try to change course is like watching the proverbial battleship try to do a U-turn in mid-Atlantic. As bulky as Harvey may be, his U-turns are done with aplomb. Certainly, the evidence seems to be building that the big multinational corporations, with their massive distribution platforms, are finding it stressful to manage creative product. When the studios were structured as relatively small, single-product companies, a Jack Warner or a Harry Cohn could simply say to an agent or a manager or a lawyer, look, guys, you're asking for a good deal. I can't afford it. I'll go broke if I pay that. Can a Time Warner or a News Corp make that argument with impunity? And that, indeed, simple-minded as it is one key reason why talent costs keep escalating. Another area where bigger may not be better is in the management business. The relationship between a manager and his client used to be sacrosanct. Your manager was the guy who not only would save your deal, he'd save your marriage. But as Gary Shandling's $100 million lawsuit against Brillstream Gray underscores, the tenuous trust between manager and client is having a tough time surviving at a time when managers have transformed themselves into massive production entities. Shandling, as one of Brad Gray's early clients, watched his manager put 10 shows on the air. He stood by as his manager sold first 50% of his company to ABC, then another 50% of his company to Universal, a feat which even Mel Brooks did not feel he could incorporate into the producers. As a professional comedian, Shandling is paranoid to begin with. All comics are. But is it unlikely that he starts to wonder, don't I deserve some of this largesse? Wasn't my manager leapfrogging in part because of my prestige and my advice? Mobilizing the same argument, a Redford or Cruz could have demanded that Mike Ovitz share some of his exit monies from CAA. After all, their superstar prestige certainly was vital in building the success of that agency. Ovitz, I'd suggest, got away with it because, as an agent, he never ventured into production. Hence, it was never in doubt who actually owned CAA. It was not Universal, and it wasn't ABC. Whatever paranoia CAA's superstars had about potential conflicts of interest, at least they knew that their agents were working for them some of the time. Now, of course, there are advantages that the big management firms may have, stemming from their size and their clout. But at the same time, something has been lost. that fabric of trust and camaraderie when two people find themselves in a foxhole together. In the opinion of some clients in this town, bigger has definitely not turned out to be better. So here's where I think it all leaves us. When it comes to building airplanes, I'm sure there are vast economies of scale, not to mention pricing advantages that go along with oligopoly, and that justify Boeing swallowing up other airplane manufacturers. The problem is that building movies and TV shows is different from building 747s. There are no economies of scale when it comes to creative output. Indeed, it is yet to be demonstrated that today's multinationals have used their greater clout and their vaster reach to make better or more successful movies, or to create product with greater cost efficiencies. If anything, arguably, the opposite is true. Arguably, the mega companies still have lessons to learn in managing their arsenals of creative talent and in adapting to the neurotic swings of the marketplace. I think one of the greatest areas, indeed, of creative deal-making in the short-term future will lie in restructuring the content side of the business to encompass split ownership, perhaps involving European as well as US partners. With these new operating units existing under semi-autonomous management. Fragmentation, in other words. Just as movies today have 2 or 3 financing partners, so will most production entities. That at least would seem to be in the cards if you talk to the titans who are restlessly stirring atop their vast multinational corporations. So I guess in the end what it comes down to is that while Jim Cameron may boast that size does matter, I sure as hell wouldn't want him dicking around with my studio. Thank you very much. Good night.
Listen, I understand. I understand that you're polite and you.
Like the rest of us.
Good morning. I'm John Frankenheimer from Loeb & Loeb. Yesterday, we explored in some detail the various options and methodologies available for financing film projects, whether they be single film projects or even modest slates. This morning, we want to examine the entertainment financing on a somewhat broader canvas. Company financing is a fundamental part of any business, whether it is designed to fuel the growth of the company, expand product lines, or ensure the very stability of the venture itself. It is much a part of the day-to-day planning of a Fox or Warner's, Sony or Paramount as it is the established independent or the hopeful startup venture. On any given day, there are literally tens of billions of dollars invested in the entertainment industry, whether in public or private forms, debt or equity. Basic financing decisions are broad questions for any company. And for the financiers, the entertainment industry presents some truly unique issues and challenges. I'm very pleased this morning that we have with us a panel which encompasses a full spectrum of alternatives to approaching and analyzing these issues. These are, in fact, in Peter's words, the chain pullers of this industry. So let me introduce them. First of all, Lauren Gassus brings a career of experience in entertainment, media, and sports lending. Starting with Crocker Bank, Loring then moved to Bankers Trust as a senior member of their media group for 5 years, and for the past 6 years has been the senior vice president and head of entertainment media lending for ING Barings. Mark Manson, an alumni from last year's panel, is a vice president with Donaldson, Lufkin, and Jenrette, and has been with the firm for the past 16 years. Mark is DLJ's lead analyst in the entertainment industry and has been recognized repeatedly by both the Institutional Investor and Wall Street Journal as one of the top analysts in this field. This is despite his incessant and somewhat indiscriminate touting of any and all Canadian media and entertainment companies. Martha Cronenshield brings to our group a much-needed sense of decorum, stability, and reason, residing as she does in Boston, a city wholly unaffected by the frenetic machinations of Hollywood or Wall Street. Martha is a founding partner of Boston Ventures, one of the preeminent private equity investors in the country, starting the company with her partners after an illustrious career at First Boston. Martha has been significantly involved with or run virtually every media or entertainment transaction at Boston Ventures, and has taken the age-old adage of buy low and sell high to new levels through their various transactions, involving a wide variety of companies, including Billboard Publications and Motown. And finally, Jerry Cromack is the managing director and head of Media and Entertainment Investment Banking Group at Furman Sells, long recognized as one of the premier investment banking houses with a unique depth of knowledge and expertise in all things involving entertainment and media. Furman Sells over the past years has been involved as an advisor or an investment banker in some capacity in major transactions involving virtually every studio and numerous major telecommunications and broadcast companies both here and abroad. And they recently served as the investment banker to the French government and CLBN in the $250 million sale of the remaining film libraries associated with Credit Lyonnais. First of all, let me thank you all for coming. I know that, and taking the time out to do this, the travel schedules of these individuals are mind-boggling. Even William Morris wouldn't route the travel plans that they have. But we're very pleased to have you. I think what we'd like to start with this morning is getting an overall description of the various types and means of providing capital to the entertainment industry. So let's start with bank debt, which is the most ubiquitous and common form of financing that virtually every company uses in some capacity or another. It cuts across all sizes of companies and all sectors of the entertainment industry. So, Loring, perhaps you could give us some sense of how you assess whether and how to lend money to the entertainment industry. What are the factors you're looking at? What are the time constraints and covenants that you're seeking? What are the time frames that are involved in terms of repayment and things of that nature? And as always in this panel, we encourage decorum to go out the window. We freely encourage exchange and debate. So.
Okay. I would like to just start off, I think, by giving everybody in the audience a perspective of the individuals sitting at the panel and what our skill sets are, because I think that's an important factor in weaving the threads through the stories that you hear today and the perspectives. First of all, appropriately leading off of the bank debt as being the lowest cost of capital layer, we are trained in our business as bankers to be skeptics. I mean, we are trained to question everything and to challenge basically every word that is given to us by management along the way and by numbers that were presented. As I look to my right here, I'd say Jerry, and I may be speaking out of hand, but this is the brilliant investment banker who is effectively the salesperson on the table, and he is here to convince his clients and to find a deal that will work for everybody, and effectively also the great compromiser, I presume. Off to my left, I would say Mark, as the stock analyst, is probably the eternal optimist. Would that be an appropriate classification?
And why not?
That's how you make your money. And Martha, I don't know, I've been thinking in the audience here earlier how I would really classify you.
Well, I think it's interesting because when Boston Ventures comes out of the First National Bank of Boston, which some of you in the audience may know was the primary lender to Hollywood way back in the 20s, when a guy by the name of Serge Semenenko, legendary name in the financing business, convinced Jack Warner to stop issuing preferred stock, and he convinced the First National Bank of Boston that celluloid in a tin had asset value and the bank could lend to this industry. We come from the banking business, and we come at our business of private equity from a credit perspective, which we think differentiates us in this market. We, for example, looked at the deal that Peter talked about earlier in exhibition and passed on it.
Okay, well, so leading in with that, when we evaluate our transactions, we ultimately take into consideration that our source of capital is effectively the deposits that individuals have put into the bank. And in our particular situation, it's predominantly the Dutch-based individuals who have invested in the bank at our headquarters. So we have a fiduciary responsibility to make sure that these people get their money back. I don't assume you put your money into a bank account at Wells Fargo and expect anything less than your principal plus interest. Therefore, we focus on fixed returns that we receive on our money, hopefully a premium over that cost of the deposit. And when we analyze the credits, we ultimately need to have an extraordinarily high level of certainty that we will get repaid and that it is not a gift to our clients. Therefore, when we looked at the entertainment industry business, and I would like to characterize and differentiate between what I call the software, the programming side, versus the hardware, we had to get our senior management comfortable with the notion of intangible assets, and was there, in essence, value for those intangible assets. And then the second step was to get our senior management comfortable that you had a reoccurring cash flow source, because ultimately, while you may get repaid with assets, your primary source in most of these situations is repayment from cash flow. So in the analysis of all of the software companies and the programming companies that we look at, we determined the length of business as one of the key criteria initially, and quite often we don't lend into startup ventures because you don't have any history to look back to. However, management is always the single most important criteria, and we will certainly evaluate transactions where management has had prior track records in other companies and it appears that they are continuing with the business efforts that they had been familiar with in the past. Then we will look at, after assuming there is some track record, we take a look at the underlying capitalization of the company, how much equity has been contributed to date, how much of that equity has been eroded either through operating losses or basically supplemented with additional capital contributions along the way. And then we ultimately evaluate what is the capital need that the company has. And the dominant capital need, of course, is for the production financing, the financing costs for production and for releasing costs. And then most of the corporations that we deal with, of course, have an ongoing overhead nut that can be significant depending on the size of the company. So we have to evaluate all of those capital requirements and try to come up with a debt level that is the maximum level for the company and yet gives us the comfort zone that we can get repaid over a reasonable amount of time. And that time frame will generally vary from 3 to 5 years. And when I talk about these companies, I'm generally talking about the independents, which are now few and far between. When we get into the larger blue chip corporate arena, we have a whole different set of criteria that we will use, and I don't want to run on with that yet.
Jerry, the next phase probably for a lot of these companies is to try to seek some kind of high yield layer as they're building out. And I know when you're putting together business plans for some of these companies, that's a very serious component. You want to talk briefly about how you evaluate that, how it fits into normal bank debt, and what place it plays in setting these things apart?
Sure. I think one of the fundamental observations just about financing in general in Wall Street, and it's true across the whole capital structure, is that there is, and Peter alluded to it a little bit earlier, there's a dynamic tension in the business because the creative community, which is behind basically making the entertainment, their initial objectives, they are managing for business, but their objectives are really to make something that's creative and good. And unfortunately, the reason that we're all sort of viewed as the skeptics and the bad guys is that from a financing point of view, while we're interested in the creative content looking good, what we're most interested in, and I think the bank that's probably the most focused on this, is does it make financial sense? And so a lot of times when you're looking at financing companies, there's definitely a dynamic tension, because while it may make perfect sense to the creative motivator behind the company to spend the extra amount of money to make this just right, unless it's particularly commercial, which doesn't necessarily go hand in hand with creative, it's not going to be particularly interesting from the financial source's point of view. So in looking at how you sort of layer financing, that sort of overlies everything that we do. With respect specifically to the high yield market and the entertainment industry, I guess entertainment is a hit-driven business, and that is not as conducive, again, to raising sort of public debentures as many other businesses, given that the investors that buy high-yield bonds, again, are concerned about getting their money back and getting their interest paid. And being a hit-driven business, if you're making hits, it's great, but basically investors in high-yield bonds very much look at cash flows and track records, and they size the amount of financing and the sort of financing they're willing to provide based on the predictability of those cash flows. So you won't find as aggressive a terms as you do in other aspects of the business, such as in broadcasting or cable, where you have a much more predictable cash flow stream. The other issue as it relates to high yield is very much one of, and I think it's true of financing in general for the entertainment industry, is that critical mass in the capital markets is very important. And basically, to access the high yield market, while you'll see some issues that are in the $75 or $80 million range, you really need to be able to sell at least $100 million of financing into the high yield markets or more. And that's because the institutions that look at investing in these need to invest in size. They have so much money to put out the door that they need to be able to buy $4 or $5 million worth of bonds if it justifies doing all of the analysis to make that investment. And as such, if they're going to buy $4 or $5 million worth of bonds, you really need a fairly liquid market so that they're not buying a large piece of the issue. They want to know they can turn around and sell the bonds too. So if you look at sort of $100 million as a good threshold, you're talking about a pretty good-sized entertainment company before you can really access the high-yield markets. And the studios clearly have access to a lot of the debt products, and the large studios are, in many cases, investment grade, so there's a whole nother set of financing. What you find is that in the medium-sized companies that are large enough to justify high yield, but not sort of the integrated studios, there aren't many of them. And you'll see an All-American, perhaps, or someone go out and raise public high-yield bonds because they're sort of in that intermediate size, and with Baywatch, they've got very predictable cash flow. But basically, the high-yield market is attractive if you can justify the critical mass. It's 10-year money with a bullet repayment, so unlike Loring that's looking to get her money back in 3 to 5 years, if you can go to the high-yield market, you have to pay a coupon, which is more expensive than Loring's coupon, but you don't have to worry about paying the money back for 10 years. The issue there is that they are typically not callable for 5 years, and so once you put it out the door, you're not going to be able to get it back in for at least 5 years. And it has very few covenants in the high-yield market. So again, if you're in that window of size that it makes sense, you can, you know, this is not equity, but generally the covenants are fairly loose. And again, Loring's covenants, if she's lending you money, she's going to tie you up a number of different ways to make sure that you're doing what you're supposed to do. So it's an attractive financing vehicle because of the repayment schedule. It's just not as applicable as some of the other financial structures in the public high-yield markets because of the size constraints and the peculiar nature of the business that we're in.
Well, that's fairly gloomy now. We found out that you have to have critical mass. They look at predictable cash flow, and heaven forbid they actually want their money back within a short period of time. So we've eliminated a lot of the opportunities for our discussion here. So let's move on to the next obvious place, which is the public marketplace, which hopefully won't put those kind of demands on us. Mark, when you're looking at the possibility of evaluating whether you want to raise money in the public marketplace, how mature does the business plan have to be? What are the strengths and weaknesses of going public? What's the timing issues you look at? And what's the current state of the market for entertainment investment in the public marketplace?
Well, with respect to...
Other than Canadian companies, which we know are
that was last
after.
year's theme.
Okay.
With respect to timing, there's an expression, when the ducks are quacking, feed them. And for those of you that don't like animal similes, another one is when they pass the tray, take the cookie. That I think that the best time to get equity money is whenever anybody will give it to you. And that there is no apparent rhyme or reason based on anything I've been able to discern in 15 years how to predict when that time will be. As a little war story, we took public a company in the television production business named Robert Halmy on the basis that they were making a miniseries about Gone with the Wind, and it was going to be a tremendous hit. And we took it public at $10 a share, and they missed their first quarter, and then they delayed Gone with the Wind, and then they missed their year, and the stock went to 14. So we sold some more equity. The next thing that happened was they got bought by Hallmark at 36, and if you talk to Robbie Halmy today, he would tell you they got a good deal. It's probably worth 120 today. But what made that a happy event for the people that happened to buy that deal was the completely unpredictable desire of a company to suddenly be in the software business. Conversely, a company that was the subject of some hooting last year, another company we took public named Film Roman, we thought we had a sure thing. They were making The Simpsons, they had King of the Hill coming, they were starting to make their own businesses. Then all of a sudden, Fox bought Saban, CBS decided not to proceed with with broadcasting as much animation as it had planned. And Film Roman, through no obvious fault of their own, and certainly through no fault of ours, plummeted from 10 to 2, where it resides today. So my experience has been that when one sells equity to the public market, one always describes the risks fully and then the upside fully. And then the next thing is you make in as subtle a way as possible and evident that the risks can't possibly materialize, and the upside you've described is in fact quite conservative. But whether you are successful in getting people to buy it depends on that completely unpredictable thing that a year ago, when Time Warner's movie business was doing terrific and the stock was languishing at 42, all of a sudden they have a bad year in music, a bad year in feature films, and now the stock is 62 because Wall Street has decided that the internet may in fact be carried over cable instead of telephones. You can't predict when is the right time. So the bottom line is, where I started, if somebody wants to pass the tray, take the cookie. When is the best time to try and get people interested? It's as soon as you're articulate and have a good idea. Now, there are some people who will make a distinction between taking smart money or stupid money or easy money. I think we could characterize Martha as smart money. She's going to be very hard to get. I think the best money is not necessarily the guy who's going to be on your board and help your business grow. It's going to be the guy who's going to say, go have a great time, because the winds of fortune are going to determine your success to a larger extent than not. I don't know if I answered your question or not,
No, I think that was very much on point.
Well, one perspective, and I don't know why I'm sounding so dismal today, but I totally agree with Mark that you should take the money when you can get it. The only issue that I think people should be cognizant of is when the markets are really hot, you can sell a lot of equities that perhaps you shouldn't be selling when the market isn't so hot. And the problem is, and there are dozens of sort of what I call burned out shells of public companies out there in the entertainment business that went public a little before they should have, and they sold shares to the public, and the public money is great, but you also do have to be accountable over time for your business plan. And if you miss your business plan, then you're stuck with a low-price stock. You still have to answer to the public market, and it's very difficult to go out and raise additional funds with that sort of $1.50 stock sitting out there. So you should take the money when you can, but you should take a look at other alternatives when you're talking about doing a small offering at the outset. There are a lot of companies, I think, that go public too soon when they probably should have gone to go visit Martha or someone to raise private equity for one more round before they went public.
Exactly, and that leads us to Martha, the hard money member of our panel. Martha, obviously your criteria are going to be a bit different, and you're probably going to want to be much more involved than someone who is raising public funds. I mean, you don't, this is your own money or the accounts that you run. You seem to have a sense that you should be involved in the management. You want to expound a bit on what again, the criteria are that you're looking at and what your objectives are, time frames, how involved you want to be, and how you see yourselves fitting into this process.
Sure, but I think before I answer that as specifically, I should speak to the audience about the difference between Boston Ventures and where we fit on the spectrum of private equity companies. There are about 600 funds operating in America today. They raised $30 billion from the markets, mostly from the public pension funds, private pension funds. We're at the right-hand end of that spectrum in that we don't traditionally take partners in our deals. We want to finance the equity ourselves. It is difficult enough to find congruence of interest between ourselves and management in terms of growth of the company, strategy of the development of the business plan, timing of the exit, without having to worry about other funds and differences in their objectives. Let's say, for example, that they're going out to raise money 2 years from now, and they decide that they need to have a big hit in their record, and the company that we might be partnered with them, we think has 5 years to go in its growth span before we're ready to sell, but we're forced into a sell position because our partner has a differing objective. Boston Ventures gets very much involved in the management of the company. We have very strong governance provisions in any of the deals that we do. So the most important thing that we look for is management. I learned early in my career from the man who trained me in this business, Bill Thompson, who succeeded Serge Semenenko, whom I referenced earlier. One of my very first meetings with him, he said to me, "I want to teach you something, young lady." That was when I was a young lady, wonderful times. He said to me, "Balance sheets don't pay back loans, people do." And I've never forgotten that, because at the end of the day, who you're doing business with, knowing your customer, as Loring would know, has everything to do with the success of our ventures. Over the course, since 1983, we've raised over $2 billion in money from a variety of sources, and we've made 41 investments, and we've had 2 investments where we didn't make money, and in those 2, we have not, touch wood, made a sector mistake. And the 2 investments that failed were management mistakes. So I guess we say in our business, you got to like the track, you got to like the horse, but you're betting on the jockey.
Fair enough. There's one other form of financing that has become fairly popular as of late in the entertainment industry. It's new to the entertainment industry, or newer. It's been around in other forms for quite some time, which is various forms of non-recourse financing with asset-backed lending, securitizations of libraries and catalogs. There are a couple of companies out there now that are very aggressively marketing this, Nomura being one of them. Prudential now has announced that they're going to have a large fund. There seem to be distinctions between the kind of lending that is done on existing libraries or catalogs with predictable cash flows, or hopefully predictable cash flows, and some of these that are being put together with major companies or established companies on new slates of projects that they have, whether they be films or something of that nature. Would any of you like to comment on how you view this, one, as an alternative way of raising funds, and secondly, what you think are the strong and weak points of getting into that? Maybe Loring, because I think a lot of the sell on these things is that these are superior methods than going to the bank, that you get a longer term, a more flexible term, the rates are lower, they're purely non-recourse, they're only securitized against specific assets, they're put in special corporate, special purpose corporations so that there's no chance of endangering other assets or other income streams. So they're basically trying to take your lunch. They want to replace the banks here. Is this a good thing or a bad thing?
We find over the years that there's always a new product that hits the street which has some favor within the investor community, and generally a lot of the products that do come forth will have a twist either because a unique return arbitrage or perhaps a reduced risk element. With respect to the current structured products that we see in the market today, we bifurcate them into three general categories. And the first category would be those that are used for what I would say financial statement re-engineering. The second category I would specify as those products which effectively shift risk for the customer, being the production or distribution company. And that's the non-recourse component that you were referring to, I think, John. And then the third category would be those products that have some sort of tax benefit, where the tax benefit can be transferred from one investor group over to the production company to ultimately yield a lower cost of capital. The products that are in the press more prevalently today are those in the first two categories, the financial re-engineering and the risk shifting. And some examples of these would include, on the financial re-engineering, the Polygram transactions, the Fox New Millennium transaction, $1 billion deal, the Universal Galaxy $1.1 billion deal, and New Line Cinema put together a $400 million financing. And all of these had banks involved in them. So in many respects, it wasn't necessarily a replacement of bank financing. It was a complement, and what happened in all of those vehicles is the banks got a lower return than what they would otherwise, but they also had effectively less risk than they might have had if they lent directly to the company. On the risk shifting category, I would lump the Village Roadshow transaction in that. I would include, I think quite clearly, the insurance-driven transactions, Phoenix Pictures, and actually I'd even probably put the Disney Constellation deal, which I think has been renamed now. Under the tax benefit deals, we have unique vehicles by country, UK sale-leasebacks, Canadian tax structures, and I think Sony recently closed a transaction in Germany. So within those categories, what the criteria that come about in the analysis of the transactions and what basically, again, the distribution or production companies are trying to accomplish is a way to access tremendous amounts of capital to fund their ongoing production needs. And if you look at an average studio budget these days, you take 10 pictures at an average cost of now 40, 50 million without the P&A, you're easily topping over $500 million. And then when you add the P&A, you're probably up to $1 billion. So that's, you know, that's not even for a full year's slate. So they have tremendous capital requirements, which can be sourced both in the public markets and then through this private market vehicle. Why it's good for the studios is because they have the ability to contribute a large number of pictures. Most of these vehicles are not done for small independents because they don't have the breadth of product, and you need a minimum product base in order to have the diversification to protect yourself. Generally, these are cross-collateralized across films so that you have one hit film to cover one loss film. And as we know, generally in a portfolio, you can just look at last year's results for any of the major studios, and generally you had two maximum 3 pictures carrying a studio slate. So that cross-collateralization component is critical in order to give the investors the protection that they need. The asset securitization component comes about where, I mean, quite simply, and just to give you a brief example of a transaction, generally what happens is you have a special purpose vehicle which is formed to acquire the rights to a slate of pictures. And they may acquire the rights either during production, but generally they will acquire them after completion of a picture. And when the rights are transferred from the studio to the special purpose vehicle, which is owned by third parties, the special purpose vehicle then pays for those rights to the studios. They're basically paying fair market value, which is the negative cost plus the financing costs. And the money that the special purpose vehicle is able to access comes either from a combination of bank revolving credit lines that are provided to the SPV or from commercial paper conduits, which tap an even lower cost of capital, but those commercial paper conduits are backstopped by bank letters of credit to provide a fail-safe source in the event the commercial paper markets dry up. So this SPV now owns the rights to the pictures, and the pictures then must be exploited. So there's a series of agreements with the distribution company that require usually minimum P&A expenditures or minimum theatrical release requirements. And then the SPV relies on the proceeds of that film through exploitation to repay the financing vehicle, whether it's the commercial paper or the bank loan. Generally, these things can stretch out to 7 years because they want to last over the film's lifetime to ensure that they're tapping all available revenue sources. But quite early on, particularly with the pictures that do poorly, you know in advance that you're never going to see full recoupment from a picture. And then you start to see mechanisms which we call clawbacks, where some of the successful pictures proceeds effectively are reserved, or they're accounted for. They stay, that cash may stay with the studio, but the SPV can reach into that pocket to repay the facility at maturity. When we walk through the deals, we see that this treatment can move the debt off the studio's balance sheet, and the debt is now sitting over at the SPV. So from a public perspective, many of the majors find it attractive because it enhances their financial ratios. And right now, there's tremendous pressure with Time Warner, with Viacom, to do everything they can to reduce their debt. So it may be for a period of time, it may be only during the production phase, or it may be over the 7-year average life of a picture that they can shift this debt off balance sheet. And then the studios may also subordinate some of the monies that they would otherwise receive in the transaction to make it more attractive for the banks or the investors at the SPV. And what I mean by that is the studios would generally take a distribution fee anywhere from 10 to 20% off the top of the proceeds that come in from exploitation. In addition, they'll generally recoup their P&A. And then you've got your residuals, and you've got an array of other payments that may arise, including a minimum return to the equity investor at the SPV. But as in the case with Universal, the bank group has the ability to claw back all of those monies that the studio retains during that 7-year time frame to the extent there's a shortfall in film performance. At the end of the day, I still see all these deals taking some film performance risk. But most people rationalize it by it being mitigated through a package of films and being spread out. So there's an intensive amount of financial analysis that goes into these things to make sure under every possible scenario you're covered. But fundamentally, you know, we've seen studios go through dry periods, and there can be some exposure there.
Well, that certainly addresses the big company slate and perspective on that. But I'd like to shift over to the other side of it. I think one of the things that was raised yesterday was the perceived dearth of funding available to independents or startups with proven management involved. And I think in one of the panels they mentioned that, gee, the only places you can go for funding is either to private individuals who want to get into the business. You're looking for the dentist or doctor or car dealer who wants to suddenly become involved in the community, or you go to somebody who has a strategic purpose in making such an investment. And invariably, whether it's film or television or music, that usually means someone involved on the distribution side who is looking at this as a way of capturing a potential growth and market share element by doing some funding. But of course, they're asking something for putting up the funding, and that is they're locking up the distribution in the future. I would think, therefore, inhibiting the value of the company ultimately. The true independence value is when they can move from distribution system to distribution system, improve their deals, improve the terms, and create free agency. One of the things that's being done in some of this non-recourse financing is making money available to those who can demonstrate, not with regard to new product, but with the existing product, that they have income streams or assets that can be securitized and is a vehicle for raising funds. So it was mentioned yesterday, what happens when Norman Lear or Grant Tinker comes along in the 90s? How do they start up a company? How do they become independent? Well, if you're the producers of ER or some other hit show, even though you may not have a full ownership position, you certainly have a predictable income stream over the next 10 years. It's pretty sizable. Isn't there a way to go out and use that as collateral to raise a lot of money and set up your own shop and be independent? Would any of you provide capital to someone who came in with a plan like that?
I think one financing that's been done in the past, I think it was done beginning of '97, that addressed that, and it isn't really a startup entity, but it is one aspect of non-recourse financing we didn't talk about was the so-called David Bowie bonds, where basically a predictable cash flow stream. He took 25 catalog albums and went out to the institutional market. And here, again, it was a special purpose entity. The cash flows are very predictable year in and year out on the catalog. Naturally, you're projecting a decline curve on the cash flows, but it was a fairly predictable and projectable stream. And they were able to achieve extraordinarily attractive terms, long-term money at rates that were something under 8%. I'm surprised that there isn't more of that being done for predictable cash flow streams. Now, that's not necessarily blending those sorts of streams to start or finance an independent company, but that's one other aspect.
Do you much care what the purpose is? I mean, David Bowie may be using that money to go buy 3 new houses. Or what if someone comes to you who says, look, I have this income stream, I want to now start a business. As long as you can securitize against the income stream, the assets, it doesn't much matter to you, does it?
Within reason, definitely. If in that case they were such predictable cash flows, you really don't care what the use of proceeds are, because you're not, as long as you're able to isolate the assets that are being financed, if the proceeds are being used to invest in something, doesn't matter what they're being used as long as they can't claw back into the special purpose vehicle.
We had a transaction that we were involved in about 3.5, 4 years ago, Castle Rock, and as you know, they're both a film production and television production company, and at the time they were into season 2 of Seinfeld. I believe it wasn't until about season 4 that we were able, as the bank group, to attribute an underlying value to the future exploitation of Seinfeld, basically the syndication rights. And, you know, I think your example, John, is an interesting one, because with ER, the television shows have always been a fascinating opportunity for banks, but very difficult, because you have a dynamic where usually season 1, season 2, and now possibly season 3, you can start to get a real handle on a show's ability to be syndicated. But prior to that, you know, all of a sudden you have a single asset that has only one possible market exploitation opportunity, and that is TV, as opposed to feature films, which have video, TV, pay, you know, the whole gamut. That at the time it was uncertain, even with that single source, that you would get repaid to the extent you lent against a future value. But we did, by season 4 of Seinfeld, start to attribute value, and those values went up as we became more certain with the advance rates in effect. So I think ER is definitely an excellent example of trying to present funds to a producer to launch into a different career. But often the studios are all over those guys. I mean, often the studios sort of find a way to be the bank for them. So the banks don't even get that opportunity in many situations.
Are the banks interested in those opportunities?
On a selective basis, absolutely. But how many ERs do you have?
True. Mark, what about from your vantage point? I mean, are there plays for the public marketplace to step into these kinds of things?
I think I've talked to someplace between 9 and 14 different organizations who claim to have taken full credit for conceiving the David Bowie securitization. And I've actually said the same thing to each of them, which is, hey, my income has been really secure. Let's secure the next 10 years of my fee stream and give it to me today. And I think that the isolated ability, what all of these things are trading off of in some shape or form are people's desires to be associated with Hollywood. I mean, I think these are fundamentally bad deals. And to expect an 8% return on David Bowie's future royalties, I mean, I want 25%. Martha's not going to go near that with, you know, a 100-foot pole. So, you know, it gets back to where I started. I'm afraid I'm going to be a one-note kind of guy today. If somebody wants to give people money for that, take it. To the issue of this, you know, we spent a lot of time talking about what the big companies do. And I don't think Michael Eisner, are you here in the audience? I mean, I don't think he thinks he's got a lot to learn from me or this panel. They know how they're going to do stuff. And they're going to try and make people compete against each other to do bad deals. And because we all want to work with Time Warner and Disney and News Corp, we'll compete against each other. We being the big investment banks, we'll do our loss leaders with them. I don't think that's what's kind of necessarily relevant to us here. I think more relevant is if you're a fledgling company, where do you get the money? And I think that based on the companies I've seen come and go, Martha's comment about management is absolutely the most relevant one, which is, if you're trying to protect what you're doing, to protect the long-term economic interest of what you're doing at the expense of getting the money today, you're probably making a mistake. Because at the heart and soul of what you are doing is you, not the assets that you are building. Unless you get incredibly lucky out of the box and happen to do an ER the first time you do a TV show, the probability is that the greatest value that you will build over the 5 or 10 or 20 years, however long you do it, is not going to be near the beginning, it's going to be near the end of what you do. So my cut on this is, if somebody wants to give you the money and wants the distribution rights or wants ownership of the asset, let them have it. So you can go on and get that project done and then go on to the next one. That ultimately the value exists in the people that are involved, as opposed to in the early stages, the assets that are being created. And with respect to the public money market getting involved in these things, it's a wing and a prayer. We were able to take public, a small music company out of Chicago named Platinum Entertainment, on the probability that the Beach Boys were going to make a big comeback. And that happened to be a window in time. And the deal got done. The stock went from 12 to 18, then it went to 3, because the Beach Boys, in fact, weren't making a big comeback. But I think the answer is that, as you know, the younger the company is, the least you should be concerned about protecting the company, and the more, or the economics of the company, and the more you should be concerned about getting done whatever it is you want to get done. And the public markets, you know, we keep talking about it, you don't have any choice. The public markets kind of, the window opens, the window closes, and you don't know when that's going to be. So maintain relationships with lots of investment bankers so that when the window is open, you can make them fight against each other to do your deal.
Mark, you touched on one thing that's sort of interesting and maybe would be instructive to all of us, and that is what people look for in terms of an internal rate of return on these investments. We pretty much know from the bank standpoint where they're going to come out, but Martha, when you're looking at a potential investment, you have investors and your own account to look after. You have pretty high standards. You have some of the biggest and most sophisticated players in the business as investors in your group. I mean, really an all-star group. My suspicion is they have pretty high expectations.
That's absolutely true. I would say to you that when we raised our first fund, we represented to our founding limited partners, who, you're right, were a lot of the big players in the industry, that we thought we could get 40% returns. We were significant, we were low in that estimation. We're now operating, we're investing our 5th fund, and one of the problems is there's too damn much money floating around in this economy. If last year the public equity groups raised $30 billion for 3 years in a row, that's why deals like the Hicks Muse KKR deal got done at multiples, in our view, that make no sense. We were involved in the exhibition business when it was in the mid-'80s, when we made the bet that there would be some real consolidation. We were buying them at 4 and 5 times cash flow and selling out at 12 and 13 times cash flow. And that window opened and closed in 2 years. So our expectation on our last fund is probably that our returns will be somewhere between 30 and 40%, but it's harder and harder to achieve those returns because of the amount of capital that's sloshing around.
Martha will have pledge slips available for you in the lobby for any of those who want to write checks this morning and see if they can get in.
But I want to respond to what Mark said earlier about for people in this audience who are looking for money. You're right. That the tray's being passed, take the cookie, keep as many relationships as you can with investment bankers because they're in competition with each other to get deals done. We're looking for relationships. When you asked earlier, I only answered really half of the question in terms of what we wanted in private equity as compared to public equity. I talked about management, but we're looking at the size of the company, the stage in the company's life, how much capital it needs to grow. We're looking at the maturity of the management. Is this a management that can stand up to undressing in public constantly in the public market? And is this a company where the CEO has enough ego to be able to deal with quarterly results, and when the analysts one quarter love them and the next quarter hate them? Can they keep their eye on the long ball? From our perspective, we like dealing with mid-cap size companies, sales anywhere from 100 million to 800, 900 million. Like a management team that's looking for more than quality, more than quantity, but quality of equity. We think that we bring something to the table because of our long-term experience in this industry. We bring them access to our relationships. We work with them, and then we take them to places like DLJ and take them to the public market.
Barry, what are you looking for? What kind of benchmarks do you have for the people that you're involved with?
Well, I think, first of all, Wall Street, I feel like I walk around town with a sign hanging around my neck that says other people's money, because we are sort of the gateway to money. So we get lots and lots of business plans, and we have to sort of weed through and find out what's good and what's not. And of course, you know, this being Hollywood, everybody wants to do what they don't know how to do. So 2/3 of the business plans are you know, people that are dentists that now want to make feature movies, and they're being conservatively just looking at film slates of $30 to $40 million instead of making the blockbuster. So it's very easy when you're looking through a lot of the business plans to eliminate many of them. Management, track record, all of the sort of fundamentals are clearly the most important thing, and that's whether you're going to the public or the private market. I think one other thing as it relates to today's topic, Wall Street money instead of some of the other areas of finance, is that on Wall Street, we're not here to film. You don't come to Wall Street if you're looking to finance a film, or if you're looking to make a record, or to fund a TV pilot. I mean, it's really about sort of companies and financing business plans that are more corporate in nature, as you led off saying. But I think that track record's important. And as it relates to startups, I think what you have to keep in mind as a startup company, or a company that you may well be seasoned in what you're doing, but you're starting from scratch, that it is from a risk profile, the riskiest point at which you're going to go out and be raising funds. It is going to be expensive. So one thing, I don't know how many business plans we get where people come in and, as you said earlier, John, say, we want to start an independent film company, and we don't want to do any deals at all. We want to maintain maximum flexibility. We're going to distribute video. We're going to do all our domestic distribution. We're going to do all our foreign distribution direct in every country, and blah, blah, blah. And the bottom line is, those are very difficult business plans to get financed. So you have to sell your soul a little bit at the outset. Those business plans that come in that have track record and management, but also say, and we've got a video deal which is, you know, takes that out of it. Maybe we've got a domestic distribution deal for the next few years with some outs, but we're going to make our money, you know, going and doing foreign distribution on our own. Those are a little more interesting from a financier standpoint, because some of the risk is taken out of it. The other thing is, I think when people come to us and look to start a business plan, they take a look at what they're going to do in the next 5 years, and we've all seen the business plans. In fact, it doesn't really matter what business the business plan is in. They all look the same. We're going to lose $12 million this year. Next year we're losing $3 million. The third year we're break even. The next year we're going to make $5 million, but by the fifth year we're going to make $164 million. And they all look the same, whether you're in any sort of industry. And what they do is they say, gee, over the next 5 years, we're going to need $68 million of seed money, so let's go out and raise it all right now. $68 million, or whatever the number is a lot of money. And what I think is probably the most financeable plan is where you come in and say, okay, we've taken some risk out of it, we've got this deal or that deal in place, and you set up milestones, and you raise your first $5 million or $10 million if you're a small company to sort of take your business plan so far. And they're milestones, and if you make some of these milestones, you can either go back to the same investors or go out and do the next round of financing. It's the way technology companies finance themselves, where you're not trying to raise all your money up front when you're at your riskiest. And so I think recognizing that you don't want to be financing every 6 months, so you don't want to just go out and raise money every time you need a couple bucks. But don't try to do it all at once. The business plans, it's all about financing credibility as well. And so when you put a business plan together, naturally you want to show $164 million of cash flow in the 5th year, because that means that Martha's return is going to be, very, very high, and she's going to let you keep most of the equity when she's discussing how much she needs for her money. The bottom line is it all comes out in the wash. The money that is going in wants to go through your business plan with you, and you need to establish credibility. So I always say, put together the most aggressive but credible business plan you can, and then go out and raise a reasonable amount of money and go from there. So you have to sell a little of your soul to basically take a little bit of risk out of the business plan. But there are, and we've over the years financed a lot of very early stage companies that have grown up very quickly. Companies like New Line Cinema or Cinar Films or QVC. Where it was the same business plan that came in, and we helped raise different rounds, and pretty soon you go to the public markets and you're off and running. So,
Jerry, have you ever done any pure startups?
We have done pure. We're in the market right now raising equity for a pure startup independent film company. Again, that's probably the most popular. We probably see 2 business plans a week, but we are doing that right now. But it's for a name everybody would recognize, and it's the sort of person that is going to attract money. Now that's probably not Martha's sort of money. You are going to go to some high net worth individuals or corporations that are looking at making an investment or getting distribution rights or something to be a piece of that. But for the right plans, there is money out there. I call it a crusade, though, and we try to be very selective about who we help to go out and do that.
Mark, I have a question for you. Martha raised something in passing that I think is an interesting issue, and that is the public pressure that is put on people for quarterly results. If you talk to the CEOs of divisions of some of these big companies, whether they be on the music side, or the television side, or the film side, they all express great concern about their inability to plan long term. And we all know that there is tremendous pressure now to open a film big, to make sure that a TV show is established within the first 4 weeks, and that a record has to come out of the box, and suddenly it's starting to look like the film business, where you have to have big opening weeks and sustain. Do you think that from the reporting standpoint has started to put a real damper on the ability of these companies to progress the value of them over the long term, that there's way too much emphasis on short-term results?
From my perspective, yes, and I don't know that that sounds self-serving. Our CEOs and the companies that are doing particularly well are the companies that do not want to be on anybody's radar screens. We're working right now with a company that's infrastructure was a total mess. So we are having to spend a lot of time and a lot of money rebuilding infrastructure. And Wall Street's not at all interested in hearing about time and labor management systems. I'm not really very interested in it myself. But certainly the street, you don't sell off time and labor management systems. You sell off of hits. You sell off of sex appeal and quarterly returns. We're investing a lot of capital now for, we think, significant returns years 3, 4, and 5. And we like being off the radar screen, and so does our management.
Mark, any thoughts?
The role of earnings for big companies, I think, is different than the role of earnings for small companies. And you can't make something different than it is. And the nature of this business is that it tends to be unpredictable on a quarter-to-quarter basis. It's also unpredictable on a year-to-year basis. But the idea that you don't want to go public because you're going to have to deal with quarterly pressures, I think that certainly if you have the appropriate underwriter, like Furman Cells or DLJ, they will convince their clients that you're not buying this for quarters. So I don't think that that should be a consideration.
Well, you may convince your clients when you go out, but certainly just look at what's happened in the market over the last several weeks. Companies losing 50% of their market cap, overnight.
I think that's truer for big companies than it is for small companies, and that smaller companies almost by definition are going to have a smaller shareholder base. Put another way, you can't make the movie business predictable on a quarter-to-quarter basis. And if you're able to be public, whether it's the movie business or television or film, if you're able to be public, by definition, people should have understood what the seasonal nature, the unpredictably seasonal nature of your business. So I don't think that should be a major factor in a decision to go public. And I'll go further. It's like, do you call your wife every day when you're on the road? And there's an expression, once fed, always hungry. If you start doing it, then you have to keep doing it. And it's got to do with the expectation. It's got to do with the expectation that you create. And I think as long as you operate within the expectations you've created, that you're going to be fine. So, don't advertise quarters because you can't control them, I guess would be my, cut on that.
Well, I was just going to say, private or public markets, you're still accountable to the people that have put money into your company. And so I don't think you get off any easier. You may have a different form of dialogue, and it might be making 2 phone calls instead of a conference call to the world about your results. But nevertheless, you're going to still be held accountable. And I mean, there's no investor out there that's willing to have the long-term vision and sit there and be able to do nothing for the interim period. And banks, quite frequently, will generally, at a minimum, we have quarterly compliant issues. And with the filmed entertainment community, and specifically the independents, you do have this huge volatility. And simply the earlier example about a delay of 1 quarter in a release, which happens quite often, can spike the results. So when you are determining at the beginning of executing a loan what each quarter will look like with respect to net worth, with respect to leverage, with respect to cash flow, I don't think I've ever seen a business plan ever met. No, I can tell you I have never seen a single set of financial projections achieved by any company we have ever worked with in this industry. So you're putting a dart up there, and hopefully you're giving enough adequate leeway, and you don't want to have to go back to the bank senior management every quarter and say, well, we've got another 3 defaults here that we have to deal with. And it's all right on a random basis, but if it's a consistent phenomena, then people start to get pretty sour about the company's ability to deliver what they thought they were going to deliver and what they said they were going to deliver. And often the one covenant that really gets consistently tripped up is the net worth covenant. That's the one where you catch most of the companies, because a film that gets released and has poor results, you've got to accelerate the write-off of the film, and so that takes a huge plunge to the net worth. And from a public accounting standpoint too, I'm sure that's an issue.
I think one thing also is you're looking at sort of public valuations and how to manage your stock price so that you can raise more money at higher prices. Credibility with the public investor is also incredibly important, and I think that you can look at multiples and ratios and this, that, or the other, but the one trap that people fall into because they're trying to create some momentum and sizzle in their stock is over-promoting something, which then everybody gets behind. Then when it doesn't go through, your stock price is going to fall. You've lost that credibility. It's much better to sort of the no surprises philosophy, and also the philosophy of, if you've got something good, make sure you're phrasing it the right way, which is, we hope this will come out. Because if you promise it and lose it, you're going to end up, those few investors that were going to give you your best valuation aren't going to come back for some period of time. I mean, you're seeing Viacom now come back after the whole blockbuster thing where its stock was crushed. It's still one of the most undervalued, I think, even at today's price, it's still a very undervalued stock, but it's just now beginning to find, and it took them a year to get investors and Wall Street back building the stock price because unfortunately, it was ahead of itself in certain areas. So credibility and not overpromising in certain areas is exceedingly important and can help. It can give you a couple multiple points for no other reason than you have loyal shareholders. And I'd say a great example of that is a company called Cinar Films in Canada, where it trades at an extraordinarily high multiple, and we keep raising more money at higher multiples for them. It's a great company. It doesn't have any greater growth prospects than any other business, but the management there has really done exactly everything that they said they were going to do with the street, and people reward them with multiples that can't be justified in any other way.
Yeah, I think what counts is performance versus expectation. And it's much easier to manage expectations than your own business. So if you start with managing expectations, that's a big help. And I think Martha would agree that that's equally true in the private sector. You go to, to people for private money. You have to be, as Jerry said earlier, aggressive enough to demonstrate that there's upside. But you really can control the expectations that are created. And what people are ultimately buying are not your projections. They're buying you as a manager. And your ability to exceed the expectations you create, I think, is what counts.
Well, let's use this as a way of hopefully ending on a somewhat optimistic note. Before we open it up for questions, I'd be curious to see what you all think are the favored sectors of the industry as we go forward into this year. And if in particular there are companies that you would single out as being good plays or companies that you see with great growth potential. Jerry's already given us a couple. Mark, you have anything?
I'd buy DLJ. We're on a roll. You want to play the entertainment business? There you go. I don't think that.
What about sectors?
I think prices are high. The company that I was most interested in a year ago was Disney, because ABC's ratings were collapsing because their animated movies were a disaster. And there was management upheaval, and now everything looks great, so the stock's probably a sell. And with respect to Jerry's comments about Viacom, they had to get their credibility back. I would argue what they had to do was have Titanic be a big movie. What took Viacom from 32 to 42 was that Titanic worked. And that the comment Martha made earlier, there's too much money out there. I mean, there's too much money out there, and returns are low. So I think we're all playing with borrowed time until some of that money gets buried underground. And we're all doing our share, except for Martha, in burying that money. So I think until we wipe out some of the liquidity, it's going to be very hard to get high returns in this business, because there's a lot of money out there chasing smaller returns.
I'm not staying for lunch because none of you are going to want to sit at my table.
Well, so much for the attempt at having optimism as an ending note here.
No, that's optimistic. There's money out there. Go get it.
No, absolutely.
That is the one thing that we've learned that is contrary, I think, to maybe some of the thought process yesterday, and that is there is an abundance of cash available. And it has something to do with cookies and ducks or something. But we'll work through the formula. Perhaps at this point we want to open it up for questions and see if anyone has something they want to pose.
But I do want to make one comment about one of the things that I think happens when there's too much money. We saw it happen at the end of the 80s. The banks are in, not necessarily your bank, but certainly several of the banks are in making loans that I would never have made as a commercial banker. And you will see them do, once there is rocky water, you will see them do U-turns just as they did at the end of the 80s. You will see them do U-turns just like they've done in Southeast Asia, which will cause diminution in value and cause companies to suffer very difficult times. So there's good news and bad news here. There's a heck of a lot of money in the market. People should take advantage of it, but they should also understand that at some point you're going to have to demonstrate performance and pay the piper.
Yeah, just to add to that, I do believe the Asia crisis will have a dramatic impact when you start to see some of the larger international financial institutions reporting potential reserves of $1 billion or more with respect to anticipated loan losses in those regions. you just get a sense that the board of these institutions is going to start to look across the horizon at a number of their businesses to make sure they are taking the appropriate conservative stances. And so I think there'll be heightened scrutiny overall. So the looser credit culture that we've had through the 90s will start to change, and we anticipate that in 1998. So the alternative for us, I mean, where we see an attractive opportunity as opposed to necessarily the equity markets right now, is looking in the bank loan market has become one of a security. In effect, there's a strong secondary market for bank loans, and there's a number of financial institutions that have either underwritten very large transactions and they did not sell down to a level that we would consider to be acceptable, and or because of other reserve positions they've had to reduce their loans in other areas. So we see the secondary bank marketplace as one that could be extraordinarily vibrant because we can pick up this paper at a significant discount. And that's what we're poised for.
I think I agree with all of that. I think one thing that we should all keep in mind is that, yes, advertising is cyclical, but the entertainment business is global. It's enormous. It's the #1 export product for the U.S. Digital technology is enhancing distribution channels, which is going to continue to drive the demand for content. Content is still king. And even if the economy as a whole goes through its cycles, I think this particular sector is one that should be able to earn above average returns over time. And so while there may be stocks that are priced very high or the market be very high if certain stocks have gotten ahead of themselves, I think fundamentally it's still an outstanding business and one in which obviously everyone here is very focused on. That should be able to continue even if the market goes through some fairly volatile gyrations.
Good. Are there any questions? Jerry, you want to take a crack at that? Is that for sure the question?
Well, I think what you're suggesting is corporations that are doing business in emerging markets, for example, where you've got convertibility issues of the currency, correct? Or they cannot get the currency outside the country from a repatriation perspective. And could you make movies, is that right, access those monies to produce your movies in that local region?
Similar to what was done in the 70s.
Yeah, I was going to say...
We had some very strange companies, including Dow Chemical, suddenly becoming film producers because it's the only way they could get their funds out of certain territories.
No, and we worked with Disney in the 80s for a number of those things down in Latin America as well. I actually haven't seen that in probably the last 3 or 4 years. It's not been something actively pursued. Why? I don't know, because it still does exist, obviously, these issues for multinationals.
I think what you have to do is you have to go to these companies and convince them it's a viable way to get their funds out. If you can show them that they have block currency issues, and by converting that into a film, and the film travels to New York and they get paid there, it's been done before. It isn't being aggressively pursued, but you have to go sort of company by company and identify who has that problem and try to sell them the solution. But it has been done.
Yeah.
There's talk of these like smaller private companies trying to gain capital by merging into existing public shells that are out there. And what are the kind of pitfalls and smaller companies would have by actually going into that process?
It's something that's been done for years, and not certainly just in entertainment, but across all companies. There's certainly nothing wrong with it. Some very large companies have actually started by becoming effectively a merger with a public shell. Pitfalls, I think, as a young company looking at merging into one of these entities, things that you might want to think about are one, obviously the obvious is that the capital structures of these public shells are extraordinarily complex, and you just need to make sure you understand where the warrants are and where the options are and all of that, because these things by nature, some of them are new companies set up by sort of boiler room shops that are, you know, you buy this, the stock goes up, you get 12 more warrants, and then it splits 1 for 6. And you just need to understand all of the complexities to know what you're really ending up with. The other thing which I've seen, which you do need to be cognizant of, is sometimes these public shells were old industrial companies or companies that were in business that went out of business, sold all their assets, and they're holding cash. You just need to take a look at what sort of legal liabilities are residing within the shell. There is, and I won't mention the name, but there's a decent-sized, very upstanding public company today that got its start 15 years ago, merging into a shell of a company that was in the pornography business. And there were some rather strange lawsuits still hanging around that had nothing to do with the business that this company were exactly in. So just take a look at what you're merging with from a legal perspective, but that's really a lawyer's, a legal question.
I just wanted to mention that it seems to me that what you're saying is that you really have to be Norman Lear or someone who has a track record as substantial as a major film production company before it's possible to raise funds from either banks or any other ways that you've been discussing. On the other hand, you're saying there's a lot of money out there. Now, for some of us who aren't, you know, another Disney or another, I don't know, Lorimar, what it was or whatever, I think that the real question is how can, if you don't have the track record with management, meaning you're not Mike Ovitz deciding to start a company, assuming he has management track record, who is I mean, how is one able to start the financing going for a company rather than having to go, as so many people do, straight to the studios with their script and their package or whatever they have? If you're looking for independent financing, and I realize that yesterday was spent in part on alternative financing, but still, given your perspective, which is that there's a lot of money out there, how can we get it without already being a studio or something as substantial as that?
Let's take the question in the context that it probably should be a company as opposed to a single picture financing vehicle or something like that. You know, one alternative obviously is the private sector and private placements and whatever, and that was discussed a little bit yesterday. There are still people out there that will do that, and you just need good legal counsel to work you through the issues in that. But for the panel, I mean, what advice would you give?
Lie. It'd start with lying. You know, Spike Lee, by the legend goes, financed his first movie, which turned into his company off his Visa card, which was 3 months oversold anyway. But, I mean, it's America. You know, it's like kind of, you just got to go out and do it, and you get it from your uncle. But none of us up here are going to go finance an individual movie, I wouldn't think, for people we haven't heard of, unless I get to be the star of it. And, I mean, what it comes down to is that people want to be involved with Hollywood. It's very sexy. Even I'm almost 50 and it's still sexy. You know, that's what you're trading off of. You got to figure out what is the asset that you're bringing. And if you're not bringing your name, then maybe you'll go to some dumb people and say, this is Hollywood, and you can be in it. But and people have been financing things for a long time, and we just make, you know, we all seem to be agreeing. It's just a little easier today than it used to be. And while it might feel hard to you, wait till it gets hard. I mean, then it'll be impossible. So you just go out and do it off your American Express card.
Yeah, the two key factors that were mentioned early on, one is management and the other is credibility, and they sort of tie together. There are companies that are small companies that are slowly building themselves out by establishing a track record as management and credibility with their investors. Companies like the Shooting Gallery, which have gone to private financing, they have the same group of investors. They keep slowly and carefully enlarging that group. They've produced, they have an established track record now, and they're growing a business with their core group of investors, and that model can work for others. I mean, if you find a group of people who will invest with you, as Jerry mentioned, I think very clearly, if you manage your expectations and you set goals that are obtainable, so you establish credibility with these people, and you walk before you try to run, you can go back, refinance, get new money. As long as you're showing that you're a real business, then hopefully get up to a level where these people are available to you to take it to, again, the next level.
To be fair, you're getting a bit of a big company bias here because we're all working on Wall Street, various aspects, and so we're looking at financing larger companies. You know, obviously the first place is go to your uncle, your brother, your cousin, but go to Silicon Valley. I mean, there are a jillion people out there who made a bunch of money in the stock market. Go to Smokestack America. There are a lot of people who have red light fever who want to be involved in Hollywood in some way and want to be a rock star or want to be, and there is money out there. You're just probably not going to have, there isn't going to be much bank money for a startup. It's really equity, and you're not going to be able to go to a lot of the traditional places to help you raise the money. But it's out there, and there are you know, agents and lawyers and just connections, and work them. That's not to say, I mean, we shouldn't be morose and say if you're not you know, Norman Lear, you can't raise money.
What about the other exchanges, instead of the big board or even the American exchange? I mean, NASDAQ, the Sheets, the Vancouver exchange, the Denver penny market. I mean, there's a lot of things out there that are available. Are these credible ways of going?
I don't think the issue is credibility. That, you know, certainly my whole thesis,
is the duck and
amazed at how
cookies kind of
cynical
thing
I've
again?
become. But, you know, just get the money. And if, you know, some Vancouver stock promoter says he can sell your deal, I mean, see if he's ever sold any deals before, because he's maybe doing the same thing to you that you're doing to him. But certainly, I just don't think credibility is the answer. I think what, you know, the answer
Remember
is
that when you
getting the
deal
money.
with this panel.
And it's out there.
Fair enough. Anyone else?
Are there reliable debt for equity, like there was in Latin America and Brazil, that can be applied to the cinema? I think the Brazilian government has made an allocation for that, but I don't think anybody's using it. And would that be something that would be considered by any of you? Debt for equity swaps.
Right, right. Yeah, we had looked at doing something like that in Mexico. We're just not seeing, you know, those opportunities arose at a time when these countries had tremendous amounts of dollar-denominated debt that they could no longer repay because of currency devaluation and turmoil. For the most part, the Latin American markets have remained fairly stable through this period. So perhaps if you want to do your film in Asia, that might be the place to explore here. Indonesia, rapidly. Yeah. Get over there. I hear it's a very creative community.
Actually, that's a good idea, because Puerto Rico has just raised a fairly large film fund. And I don't know other countries, you'd have a better sense of that. But that is a source, and we hadn't mentioned that.
Yeah. Yeah, and I think they're fairly creative, and that would be, though, on a single picture type of basis, not a corporate financing. It's a good vehicle, though, and you can get some attractive discounts, anywhere from 10 to 30%, depending on the circumstances.
Anyone else? If not, again, I want to thank you all for joining us. I know you've appreciated